I want to tell you something that took me years of losses, years of sitting in smoke-filled trading rooms watching the ticker tape crawl, years of being right about the direction of the market and still losing money before I finally understood it. The market is not random. It never has been. Beneath all the noise, beneath all the headlines and the earnings reports and the panicking crowds, there are two forces and only two that have ever moved price in any market, in any era, on any instrument: supply and demand. That is it. That is the whole game. And once you learn to read those two forces with discipline and precision, you stop gambling and you start operating. You stop reacting and you start anticipating. You stop losing your shirt on setups that feel good and start selecting only the A-plus trades, the kind of trade where the odds are so heavily stacked in your favor that entering it almost feels unfair. Now, before we go further, I want you to go down to the video description right now and check out our ebook, Thinking Like Jesse Livermore, Mastering the Market with Discipline, Patience, and Risk. That book will reshape the way you see every chart you ever look at. And while you're there, grab the second one, the Livermore Journal, a 90-day trading psychology workbook, because what I'm going to teach you today is strategy. Yes, but without the psychology, strategy is worthless. The links are in the description. Open them, read them. They go hand in hand with everything we are discussing here today. Now let us begin. Step 1 of this A-plus supply and demand strategy is identification, and I mean real identification, not the lazy kind where you draw a box around any little consolidation and call it a zone. That is not what I am talking about. I am talking about learning to see where institutions, the big money, the banks, the funds, have left their fingerprints on the chart. Because here is something most retail traders never stop to consider. You cannot move millions of units of anything, stocks, currencies, commodities in a single moment without leaving a mark. It is physically impossible. When a bank wants to accumulate a massive long position, they must do it quietly, over time, in small pieces. And when they are done accumulating, when they lift their foot off the buy orders and let price run, the chart will show you exactly where they were sitting. That is your demand zone. That is where the institution decided price was cheap enough to load up. And when price returns to that level, 9 times out of 10, those same institutional buyers are still there defending their position, adding to it, refusing to let price move lower. That is not coincidence. That is the invisible hand of smart money, and your job is to follow it. Now, how do you identify these zones with precision? You are looking for one specific pattern, a sharp, impulsive move away from a consolidation, not a slow drift, not a grinding trend. A sharp, explosive departure. That departure is the tell. It tells you that at that exact consolidation level, someone with enormous firepower stepped in and decided, not below this price. They drew their line in the sand. You draw yours right on top of theirs. I have discussed the mechanics of reading institutional footprints in much greater detail in our previous video, How Smart Money Moves the Market Before You Even See It. If you have not watched that yet, I strongly recommend you do so after this one. It will make everything I am saying here click into place with stunning clarity. You can find it on our channel. And speaking of the channel, if you have not yet subscribed, please do so right now. Hit that subscribe button and turn on notifications. We publish trading education at this level consistently, and you do not want to miss a single session. Hit the like button as well if you are finding value here. It tells us to keep going, and it tells the algorithm to put this in front of more traders who need it. Now, back to identification. There is something else I want you to understand about demand and supply zones that most educators gloss over. Not all zones are equal. A zone formed on a higher time frame, the daily chart, the weekly chart, carries far more weight than a zone formed on a 15-minute chart. Why? Because the institutions operating on that higher time frame have deeper pockets and longer conviction. When price drops back into a weekly demand zone, you are not fighting a single desk at one bank. You are fighting every institution that touched that level over a span of weeks or months. That is a wall. Respect the wall. The A-plus setup is always one where multiple time frames are aligned, where the weekly zone and the daily zone are sitting in the same neighborhood, stacked on top of each other like armor. When you find that alignment, you have found something worth circling on your chart and watching with patience. Patience. That word, I cannot stress it enough. In all my years in the markets, and there were many, with enormous wins and devastating losses, the single greatest edge I possessed was not my ability to read a chart. It was my ability to sit on my hands and do absolutely nothing until the moment was right. The market will always offer another opportunity. The trader who chases every setup leaves money on the table and sanity on the floor. Wait for the A+. Only the A+. Step 2 of this strategy is confirmation, and this is where most traders who understand zones still fail. They identify a beautiful demand zone, they watch price drop right into it, and then they jump in the moment price touches the line. And sometimes it works. And sometimes they watch price slice right through their zone like a hot knife through butter, and they stand there confused, asking what went wrong. What went wrong is that they skipped confirmation. They traded the location without trading the signal. You must never do that. Location tells you where to look. Confirmation tells you when to act. One without the other is incomplete. So what constitutes genuine confirmation at a supply or demand zone? I want you to think about it from first principles. If a demand zone is truly a place where institutional buyers are active, then when price returns to that zone, you should see evidence of that buying. You should see price slow down. You should see rejection candles, wicks pushing back up from the zone, telling you that every attempt to go lower was met with aggressive buying. You should see the spread on those candles compress, as if two immovable forces are pressing against each other. And then this is the moment you should see a decisive candle close back above the zone's upper boundary, signaling that the buyers have won the battle and price is preparing to move in their direction. That is your confirmation candle. That is your entry signal, not the touch, the candle. Now I want to link this concept to something we covered deeply in our earlier video, the art of the entry. Reading candles, like a professional trader. In that video, we broke down every type of confirmation candle you need to know the engulfing, the pin bar, the inside bar reversal, and showed you real chart examples of each one forming at key supply and demand zones. If confirmation is a concept you are still developing clarity on, that video is essential viewing. Go back and watch it after this one. The link is on our channel, and I will mention it again at the end of this session. Now let me give you the 3 confirmations I personally look for, and I mean all 3, not 1, not 2, all 3, before I consider a setup A+ worthy. First, time-based stall. When price enters a demand zone and simply stops moving lower when it consolidates, grinds sideways, takes its time, that is evidence of absorption. The sellers who pushed price into that zone are meeting buyers who will not let it go further. The fight is happening. The longer the stall, the more significant the underlying demand. Second, the rejection wick. I want to see at least one candle, preferably more, with a long lower wick reaching below the zone and closing back inside it. That wick is a story. It says, price tried to go lower, buyers came in immediately and aggressively, and price was pushed right back up before that candle closed. If you see 3 consecutive candles, each showing that same lower wick rejection pattern, you are looking at one of the cleanest demand signals a chart can offer. Third, the momentum shift candle. After the stall, after the wicks, I want a candle that closes with genuine body above the zone's upper boundary, a candle with conviction, with size, with the kind of range that says the balance of power has changed. Not a small doji, not a tiny inside candle. A real, purposeful momentum candle that tells you the buyers have finished accumulating and are now pushing price where they want it to go. When all 3 of those confirmations align at a high time frame, institutional grade demand zone, that is an A+ setup. That is the setup I have been patient for. That is the only setup I take. Because here is the truth about this business that I learned the hard way. It is not the frequency of your trades that determines your success. It is the quality. One A+ trade a week, executed with precision and discipline, will outperform 20 mediocre trades executed out of boredom or fear of missing out. The market does not reward busyness. It rewards precision. It rewards patience. It rewards the trader who knows how to wait. Now let me address something about risk, because we cannot talk about confirmation without talking about what happens when you are wrong. And you will be wrong sometimes. Every trader is. The question is not whether your analysis will occasionally fail. It will. The question is whether, when it fails, you have positioned yourself so intelligently that the loss is a minor inconvenience rather than a catastrophe. That is why confirmation is so vital. It tightens your entry. A tighter entry means a tighter stop loss. A tighter stop loss means less capital at risk per trade. And less capital at risk per trade means you can be wrong multiple times in a row and still have enough in your account to take the trade when the A-plus setup finally comes. Preservation of capital is the foundation of everything. Nothing else matters if you blow the account. Take care of your losses and your profits will take care of themselves. We have an entire dedicated video on position sizing and risk management that I want you to watch in conjunction with this one. It is called The One Rule That Keeps Professional Traders Alive, and it is on our channel. That video and this one, watched together, form a complete system. Do not wait. The information is there for you. And while you are on the channel, leave a comment below this video. Tell me which part of supply and demand you struggle with most. Tell me what setups you find hardest to identify. Tell me where the market has humbled you. I read every single comment, and your questions shape the content we create next. This channel is not a one-way broadcast. It is a conversation. Your voice matters here. Step 3 of this strategy, the step that separates the traders who study supply and demand from the traders who truly master it, is execution combined with management. Because here is something no indicator, no course, no ebook can manufacture for you. The ability to pull the trigger at the right moment and then hold your position with ice in your veins while the trade develops. Most traders are defeated not by bad analysis but by emotional interference after the entry. They enter correctly, the trade moves in their direction, and then a small pullback makes them close early for a fraction of the profit they were entitled to. Or worse, they close at break-even the moment price wiggles, and then watch helplessly as the trade runs 50, 100, 200 pips without them. Execution is a skill. Management is a skill. Both can be learned, but only through deliberate practice and an honest, unflinching relationship with your own psychology. Let me talk about execution first. Your entry must be calculated, not emotional. When your confirmation signal appears, when those 3 elements I described are all in place at your identified zone, you do not hesitate. Hesitation is the enemy of the disciplined trader. You have done your analysis, you have waited for your signal, and now the signal has come. You enter. You place your stop loss below the demand zone, below the lowest wick that formed during the confirmation process, with a modest buffer. You define your target based on the next significant supply zone above price, or the most recent swing high, whichever comes first. You calculate your position size so that if price hits your stop loss, you lose no more than 1 or 2% of your trading capital. And then you let the trade breathe. That last part, letting the trade breathe, is where I want to spend time, because it is the part that most costs traders their profits. Once you are in a valid A-plus setup, minor price movement against your position is completely normal. Price does not travel from A to B in a straight line. It moves in waves: impulse, then retracement, then another impulse. If you have entered at a genuine institutional demand zone with proper confirmation, a pullback of 20 or 30% of your anticipated move is not a sign that you were wrong. It is the market doing what the market does, testing, retesting, shaking out the weak hands before continuing in the direction of the dominant institutional order. Your job is to remain calm, trust your analysis, and stay in the trade as long as price has not violated your stop level. A trade is only definitively wrong when price closes below your stop loss. Until that happens, it is simply in progress. Now let me give you one final critical element of management that elevates this entire strategy to a professional level: scaling out. I never advocate closing an entire position at a single target level. Here is why. You entered a trade with a defined target based on the next supply zone. But sometimes, not always, but sometimes price will blast through that supply zone as if it were not there, because a higher time frame institutional order is driving a much larger move. If you close your entire position at your first target, you collect your profit and walk away satisfied, while the trade continues another 300 pips in your direction without you. That is not optimal. Instead, Close half your position at your first target and move your stop loss on the remaining half to your entry point, making the second portion of the trade risk-free. Let that second half run. If it stops at break-even, you still captured the first target. If it runs to the next supply zone, you have extracted maximum value from the move. That is how professionals think. That is how you turn good trades into great ones. I want to also point you toward our video on how to scale in and out of trades like the institutions do. It is on the channel and goes deeper into everything I just described with live chart examples and real trade walkthroughs. Pair it with this video and you will have a complete end-to-end system for executing supply and demand trades at the highest level. And now I want to say something directly to you, not as a trader to a trader, but as one human being who has experienced the full spectrum of what this journey offers, to another who is somewhere in the middle of theirs. This market will test you in ways that have nothing to do with charts. It will test your patience when opportunity seems to have abandoned you. It will test your discipline when a mediocre setup whispers that it is good enough. It will test your resilience when a perfectly executed trade hits its stop loss and the loss feels personal, feels like a verdict on your intelligence, on your worth. And in those moments in the dark, quiet moments after a hard week in the markets, I want you to remember this. The traders who survive are not the ones who never lose. They are the ones who refuse to quit. They are the ones who study harder after a loss rather than giving up. They are the ones who return to their charts not with desperation, but with curiosity, with discipline, with the unshakable belief that the next A-plus setup is coming and they will be ready for it. You have that in you. That is why you are here. That is why you watch these videos and study and push through the frustration and come back for more. The market rewards that kind of commitment, not immediately, not always obviously, but inevitably. Stay the course. Before you go anywhere, please go to the video description and get our ebooks. Thinking like Jesse Livermore, mastering the market with discipline, patience, and risk. It is the philosophy that underlies everything I have shared with you today. And the Livermore Journal, a 90-day trading psychology workbook. It will help you build the inner discipline that no chart pattern can give you on its own. Both links are in the description. They belong in your trading library. And if this video added value to your journey, hit the like button. Share it with a trader you know who is struggling with entries or zone identification. Subscribe to this channel so you never miss what we release next. Leave a comment below telling me your biggest takeaway or the question you want answered in the next video. Your engagement keeps this community alive, and this community exists for one purpose only: to help you become the trader you were always capable of being. The tape is moving. The zones are forming. The A-plus setup is coming for those who are prepared. Be prepared.